After studying this module, you will be able to know what is non-financial reporting, learn why there is a substantial increase in non-financial reporting, identify different standards governing non-financial reporting, and know the uses and importance of non-financial reporting. Let us begin this module by discussing the relevance of non-financial reporting. The value relevance of non-financial information has increased remarkably over the last several years. Most top executives at large multinational firms believe that non-financial performance measures are more valuable than traditional financial measures in addressing long-term value. The shift in information has stimulated a substantial increase in the volume of non-financial information conveyed by firms to their stakeholders and other market participants. Current mandated financial reporting does not give complete picture of a firm and is too short-term in orientation. In a world where the market value of the firm is decoupled from value of its underlying assets, non-financial information offers a tool for measuring the firm value arising from intangibles and future cash flows that is missing from traditional financial reports. Over recent years, the level of interest from stakeholders in corporate environmental, social, and ethical performance has risen significantly. Non-financial reporting, often referred to as sustainability reporting, enables businesses to be transparent in communicating these non-financial aspects of their management and performance. While non-financial reporting is currently voluntary, it offers significant benefits to organizations in terms of stakeholders' engagement and reputation. This overview provides some clarity on reporting frameworks, principles, and types of assurances as well as a source of information. Given the limitations of historical financial information, an important question arises about what other information is of benefit to potential stakeholders. In a study found that retail investors were most concerned with non-financial disclosures that more directly affected future earnings, such as the disclosure of leading economic indicators. In a recent review of developments on the integration of financial and non-financial information, integrated reporting is a means to providing a more coherent, balanced, and complete picture of company performance centered around strategic objectives and business models and sensitive to the multiple drivers of value for today's business. Non-financial disclosures help stakeholders to validate and predict the performance of the firms as a non-financial are more futuristic in approach. It helps various stakeholders, specifically investors, to justify their investment as strong non-financial information helps to support the sustained performance of the firm. We can classify non-financial disclosures into two compartments, namely economic and non-economic indicators. Economic indicators here mean the metrics which directly relate to performance of the business, such as market share, quality rankings, customer satisfaction, employee satisfaction, turnover and innovations, etc. While non-economic indicators are those matrices which are not directly related to the business of reporting entity like expenditure on environment, corporate social responsibility undertaken expense on employees' betterment, etc. Firms are keeping their stakeholders informed about both indicators, but with the growth in demand of responsibly produced and fairly traded goods, and focus has been shifted towards non-economic indicators. Corporate social responsibilities, commonly known as CSR activity, is an area of intense and increasing interest both on the practice and academic fronts. Assets under professional management and invested with a social responsibility focus have also grown dramatically over the last 10 years. Investors choosing social responsibility investment strategies require access to information which is not just provided through traditional financial statements and analysis. At the same time, a group of mainstream institutional investors have encouraged a movement to incorporate environment's social and governance information into equity analysis, and multi-stakeholder groups have supported enhanced business reporting on these issues. Investors are not only interested parties. CSR activity provides an increasing focus of product development and marketing practitioners. Research demonstrates that certain type of CSR activity produces value for firms in terms of brand loyalty and marketing advantages. In any community, it is common to find retailers donating to local charities, sponsoring Little League sports teams, and proudly displaying the national flag. These actions demonstrate the retailer's adherence to unwritten but powerful normative rules of acceptable social conduct, such as becoming involved with the community and promoting national pride. Major limitations with non-financial information are of measurement and materiality. Few non-financials can be easily measured, like number of retail store or diversity, while others are not easily measurable, like employee satisfaction or customer satisfaction. So, each reporting firm uses different criteria for measuring non-financials. This leads to problems of non-comparability with other firms. Other major concern is of materiality of non-financial disclosures, as all financial and non-financial information is not material, but for financial information, some quantitative criteria can be set up, but same is not possible with non-financials. So, some non-financial information may be left out because it is considered as non-material by the reporting firm, but it may be material to certain groups of stakeholders. A corporate social responsibility initiative has become more widespread and corporate behavior shifts. The public needs clear ways to evaluate a company's social, economic and environmental performance. Non-financial reporting is essential for public stakeholders to gauge how well companies are performing in these areas, as they instill accountability in firms, drive sustainability improvement, and contribute to the development of better corporate practice. Commitment to CSR and non-financial reporting varies widely. Many companies that recognize their social and ethical obligations have corporate responsibility programs. Other companies implement CSR, financial, employment, or for brand reasons. Recent evidence, such as Harvard professor Michael Porter's work, suggests CSR can be a source of opportunity and competitive advantage for companies. Porter claims business and social objectives are interdependent and can optimize success and long-term sustainability. He also claims stakeholders have begun to highlight poor social performance and its financial risk. Non-financial reporting broadcasts responsible corporate behavior which can contribute to long-term business sustainability, promote a brand, and please stakeholders. It is difficult to measure the success or impact of CSR initiative due to the fact that the reporting practices are not standardized among other reasons. Still, many companies attempt to create comprehensive reports to publicize their CSR developments. The UN Global Compact, which focuses on promoting human rights, labor, environmental, and anti-corruption initiatives, supports the Global Reporting Initiative GRI. The GRI has a framework for non-financial reporting that includes a method to evaluate companies' economic, social, and environmental performances coherently and strategically. The GRI can be used by companies new to CSR and non-financial reporting as well as by those with a long history of corporate responsibility. General CSR reports are produced by many companies worldwide, but reports lack consistency or indicators to allow comparison. The UN Global Compact continues to strive towards standardized reporting by requiring all member organizations to complete a communication on progress report annually and share information about their sustainability efforts. The UNGC promotes GRI compliances, and the GRI framework includes flexible requirements that fit all types of organizations, indicators for success, and supplements for particular industries. Let us now discuss the conceptual framework of non-financial reporting. The choice of broad theoretical framework depends on whether we approach the question of CSR from an economic or an ethical standpoint. Ethical theories indicate that these activities should be promoted because they are the right thing to do. Economic theories indicate that these activities should be promoted only to the degree that they create shareholder wealth through increasing profit. Virtually all theoretical approaches carry the implication that it is not enough to partake of a CSR action. It is necessary then to disseminate information about the action that has been taken. A matter of significant difference between the theories pertains to what actions should be taken and who should be informed of them. To some extent, the answer to the first drives the answer to the second. If the primary goal of the activity is to enlist the support of a particular party, the firm will of necessity publicize the activity through channels like to reach that party. Therefore, we should look into different theories which offer a brief overview of why the CSR activity. Neoclassical economists. Traditional economic approach to the question suggesting that managers should apply net present value analysis to all potential CSR activities and take only the actions that result in positive NPV and thus increase shareholders' wealth. An important element of this theory in the corporate social responsibility concept is the neoclassical notion that the shareholder is the only stakeholder of significant interest. A problematic issue for the traditional neoclassical approach to corporate social responsibility is that, unlike production decisions, CSR activities and their outcomes may not yield the mathematical traceability necessary for reliable NPV analysis. Marketing strategy. Another stream of inquiry that suggests that corporate social responsibility may be motivated mainly by wealth concerns is found in the marketing literature. Empirical evidence suggests that consumer beliefs about products are influenced by the information that they possess both about corporate entity and about the producer's corporate social responsibility, even though the CSR policies are often unrelated to the company's ability to produce. Both items are key elements in creating a good corporate reputation, posted by numerous theorists to provide a source of economic benefits to an organization. Political economy. A third theoretical approach considers these actions through the lens of a political economy. In this approach, the firm is not considered to be an economic entity that can be divorced from its social context. It is instead an organic organism that is a party to a social contract with the other members of this context. In order for the firm to survive, it must obtain the support and approval of its stakeholders, whether those be primary stakeholders, that is, those without whose support the firm cannot function at all, including customers, suppliers, or providers of labor and capital, or secondary stakeholders such as those who are indirectly affiliated but in a position significantly to influence the firm's success, including regulators and media. Shareholders' demands and intangible assets. An additional stimulus for disclosure may be categorized as a pragmatic management response to a demand situation. The intense growth of SRI assets suggests an increasing demand for CSR disclosures and presumably for CSR actions. These disclosures may be a simple response to the information needs of the shareholders. Financial data is historical in nature and yields a limited perspective of the firm, insufficient to permit a sophisticated understanding of the firm's future prospects. While these concerns are relevant to the interests of all equity holders, they are of particular importance to SRI investors. SRI investing does not disregard rigorous financial analysis. It simply adds to that analysis a consideration of the social and environmental consequences of the investments, such as environmental, health and safety, diversity, and human resource issues. Traditional financial statements are not adequate to supply informational needs indicated by this type of investing activity. Many international companies have therefore responded by providing a variety of CSR disclosures. Ethical theory. This concept arises out of Murthy 2007, which has laid down the fundamental basis of business ethics and corporate social responsibility. It is argued that business ethics and corporate responsibilities are two sides of the same coin. Murthy has shown that corporate responsibility consists of environmental accounting, corporate governance, and corporate social responsibility. This study talks about the paradigm shift in the philosophy of business from just concerned with their business to a broader approach which takes into account the environment in which the business operates. The new perspective has broken down the compartmentalization of business and society, and it has been realized that social and environmental issues can no longer be addressed entirely through a unilateral imposition by the state through a legal framework. In the light of this view and development, the business had to gear itself to rethink, to develop new theories and practices of management to align itself with this breakdown. Besides this, the phenomena of a rapid decline in the role of the state and withdrawal of the state from the social space have created a vacuum. As the needs of the society and imbalances in the society have not changed, and therefore business has to emerge as the filler. The role, relationships, and realms of the three entities, the government, the business, and the society, have changed. Standards. Despite the growing trends in SRI investing and the benefits of implementing CSR policies, reporting on these issues continues to be inconsistent. Due to this inconsistency, there has been a need of some global standards so that there can be convergence in the reporting. There are two main purposes of corporate responsibility standards. One is to help drive and improve corporate performance through more responsible and accountable business practice. The other is to provide a clear and common understanding of what is meant by such concepts as sustainable development and corporate social responsibility. One of the standard setter is Global Reporting Initiatives. The Global Reporting Initiatives, commonly known as GRI, is a network-based non-governmental organization that aims to drive sustainability and environmental, social, and governance reporting. GRI produces the world's most widely used sustainability reporting framework to enable this drive towards greater transparency. The G3 guidelines set out the principles and indicators that organizations can use to measure and report their economic, environmental, and social performance. GRI is committed to continuously improving and increasing the use of guidelines which are freely available to the public. GRI was founded in the USA in the year 1997 by CERES and the United Nations Environment Programme UNEP and was originally based in Boston, Massachusetts. In 2002, GRI moved its central office to Amsterdam, where the secretariat is currently located. Among other main standards, one of them is ISO 26000. The ISO guidance on social responsibility emphasizes the value of public reporting on social responsibility performance to internal and external stakeholders such as employees, local communities, investors, and regulators. The emphasis represents an important level of international attention to the issue of reporting and is aligned with GRI mission to make disclosure on economic, environmental, and social performance common practice. In India, direct guidelines for non-financial disclosures are not given, but voluntary guidelines are given by Ministry of Corporate Affairs. The guidelines emphasize that businesses have to endeavor to become responsible actors in society so that their every action leads to sustainable growth and economic development. The new set of guidelines presented in the year 2011 is a refinement over the corporate social responsibility voluntary guidelines set out in the year 2009, released by the Ministry of Corporate Affairs in December 2009. Let us now summarize what we have learned in this module. Financial reports are becoming increasingly complex. Thus, investors have difficulty in understanding the economic substance of transactions and backward orientation. Thus, for the most part, they provide information about the past, while investors need to understand how companies' performance will evolve in the future. Given these limitations of historical financial information, an important question arises about what other information of benefit is for potential stakeholders. The gap can be filled by non-financial disclosures. Accounting information is now being substituted or complemented by non-financials for various purposes such as incentive compensation, prediction of costs and profits, valuation of firm, detection of fraud, etc. Financial information becomes more valuable if it is supported by non-financials.